Hi, welcome to Melissa's Money Mindset, a channel dedicated to helping you feel empowered to make smart money moves. Today, we're going to be talking about the top 10 reasons that I choose to invest in real estate. So if that sounds good to you, stick around. Please do me a huge favor, like this video, subscribe, and don't forget to hit that notification bell. So let's get right into it. The first advantage is leverage, which is an advantage that a lot of other asset classes like stocks, unless you're trading on a margin account, or commodities, frankly don't have. Leverage basically allows you to own and control a large sum of real estate for a lesser amount of money, meaning that you're not paying for the real estate in full. Typically, you put down 20, 25, even up to maybe 45% to control an asset that's going to cash flow and make you money. For example, let's say you're buying a $500,000 house with a 30-year fixed rate mortgage. You can put down 20% to avoid paying mortgage insurance, and you can control that asset for $100,000 down and a pretty reasonable monthly payment instead of paying for it outright. If you put less money down, your monthly payment will be higher, but you'll control that same asset for as little as 3.5% down, which would be roughly $17,500 plus about $8,750 for the upfront mortgage insurance cost. So leverage is important depending on what type of property you're buying. So if you're buying a primary residence, which is where you're personally planning on living, you have a few options in terms of loans. So if you're looking for lower down payments and just better rates overall, you might be a good candidate for an FHA, which is a Federal Housing Administration loan, or a VA, a Veterans Affairs loan if you are a veteran. These are both great options for first-time home buyers. Sadly, in the past few years, at least where I live, people using these types of loans have probably been priced out of the market. I remember 2 years ago, even 1 year ago, houses going for $200,000 over ask, $500,000 over ask. And unfortunately, people using these type of loans just can't compete with offers like that. But now that the real estate market is cooling off a little bit, it might be the time for people utilizing these types of loans to kind of step forward. More specifically, the FHA loan does require mortgage insurance. So you'll have to pay an upfront cost of 1.75% usually of the loan amount, and then annually 0.15 to 0.75%. The minimum down payment for this loan type is 3.5%. That's assuming your credit is 580 or greater. If your credit score is less than that, you'll probably have to put 10% down. Now, a VA loan or a Veterans Affairs loan is quite different because it doesn't require any mortgage insurance, and it actually doesn't require any down payment at all. So if you're a veteran, this could be a really great option to look into. Now, let's talk about the difference between conforming loans and non-conforming loans. So conforming loans comply with the government guidelines for mortgages, and they can actually be sold to other government-backed enterprises. Generally, they have lower interest rates, but they do have more rigid qualifying criteria than non-conforming loans. So a type of conforming loan is a conventional loan. It's what you traditionally think of when you think of a mortgage. And usually the loan originates with Fannie or Freddie. You can put as little as 3% down, but you will be paying mortgage insurance if you don't put at least 20% down. So keep that in mind. This type of loan does have more strict qualifications. So you need a minimum credit score of 620 versus the 580 that we talked about before. And your DTI, your debt to income ratio, needs to be less than or equal to 50%. There are a few different types of conventional loans, so let's talk about those too. A fixed rate home loan is the most common type of home loan, and it has terms that can range anywhere from 15 years to 30 years, probably 30 years being the most common. This type of loan is great because it's kind of a set it and forget it type of loan. You lock in the interest rate that you have, and the interest rate never changes over the course of your loan. Now, in contrast to a fixed rate mortgage, we have ARMs or adjustable rate mortgages. These types of loans have an introductory period, which essentially means that your interest rate is locked for an agreed upon term, generally somewhere between 5 to 10 years. And then after that, the rate can rise or fall depending on the current market rates. So once you're done with that introductory period, the adjustment period starts. So it's important to pay attention before this adjustment period starts to how you think the market is going to trend over the next few years. If you think interest rates are going to skyrocket, you might want to refinance now to lock yourself into another introductory period, or maybe you want to start a 30-year fixed mortgage. Now, there are some loans that are called non-conforming loans, and these are loans that don't comply with those government guidelines that we talked about before. So these are mortgages that cannot be sold to other entities. These can have rates similar to what Fannie and Freddie are offering. I've actually seen a good amount at our bank that are lower, which is great. If you have a good relationship with your bank, you might want to ask them about this, but just pay attention, obviously, to the loan terms. And they often have more flexible credit requirements. So the first loan type from this category is a portfolio loan, which is basically a type of mortgage that lenders originate, and they are retained within that bank, your local bank, instead of being sold on the secondary mortgage market like most conventional loans are. The benefits of a portfolio loan are that they often have faster funding times, so you're not waiting around for the usual 30 days until closing, so you can have a faster close, possibly making your offers on real estate a little bit more competitive than other candidates. And they usually have more flexible underwriting standards, which can be helpful depending on your financial situation. The other type of loan in this category is a jumbo loan. So these are really high value loans that exceed the Federal Housing Finance Agency conforming loan limits. So these are pretty common in more expensive parts of the country, California, Washington, Colorado, New York, Florida. These are all pretty commonplace loans. This type of loan has varying down payment requirements. You may actually be required to have 12 months of mortgage payments in a bank account that you can show proof of funds for in order to get approved for this type of loan. Also, it depends what state and what county you live in. They all will have different limits just based on cost of living in your area. So I would just either ask your banker about it or you can look it up online to find the limits. So we can use the same logic if you're wanting to buy a commercial apartment building. So let's say that you get a commercial loan with a term between 3 and 10 years. They're usually amortized over 20 to 25 years, similar to the ARM that we discussed previously. You want to put down 25%. That's actually the minimum for investment properties. But now I'm often seeing people have to put down 30, 35, 40, even 45 to 50% for properties to cash flow. But still, you're able to control a hopefully cash flowing asset for less than the total amount or the total value of the property. So let's say that the property you want to buy is $1 million. So you put down $250,000 minimum and you finance the rest. Theoretically, the cash flow that you make from that property should be able to cover the mortgage and then some. And then in the game of real estate, you're also gaining appreciation while you control a cash flowing asset. So you're earning cash flow, you own an appreciating asset, and you can depreciate the income that you earn from that asset against your non-passive income. Reason number 2, I invest in real estate, and all real estate investors' favorite part, cash flow. So cash flow is your net income from your real estate investments after you've paid your mortgage and all other operating expenses. So if you're doing your job well, meaning that you bought your property right, you didn't overpay for your property, you have good tenants in there, and you've optimized your rents, then assuming there aren't too many major expenses, you should be cash flow positive, though keep in mind, if you're not on top of things, you can be cash flow negative too. So let's talk about the NOI or the net operating income for just a minute. So this basically is the operating profit that's calculated by taking the gross income minus any operating expenses. So this is pretty important, especially for commercial real estate, so that you can quickly see how well a property is doing and how much money they're bringing in. So let's look at this example. It looks like this property brings in a gross rental income of $100,000 per year. Let's say they didn't have any vacancies that year. That was a good year. Their effective rental income was $100,000. They paid $15,000 in property tax, $10,000 in insurance, $10,000 in maintenance. They paid $15,000 in utilities, general admin, legal, and all of that jazz. They paid $5,000. So their total operating expenses were $55,000, meaning that their net operating income was $45,000. And then it looks like they owed $30,000 on a lender debt service. So their actual cash flow on this property ended up being $15,000. So another important thing to discuss is exactly what affects cash flow. And there actually are quite a number of things that can be factored in here. So the first can be how you bought the property. As I talked about previously, prices, especially where I live, have been absolutely astronomical over the past few years. And people are overpaying on properties like crazy. I imagine that investors here, some of them have to just be in a world of hurt, just completely underwater. So make sure you're not overpaying for your properties. Also pay attention to your interest rates that you're getting. We obviously all saw interest rates spike, and the Fed had talked about potentially lowering interest rates this year. Unfortunately, inflation isn't quite corrected yet, and so I don't know that we're going to see an interest rate cut this year. It's pretty hard to make anything, at least where I am, cash flow when interest rates are this high. Another important factor to consider is rent, how much you're renting each unit for. It's really important as a property owner to kind of keep your finger on that real estate market pulse. I'm always on Zillow, Realtor, the MLS, just looking at how much things are listed for if I'm looking at buying a property, or even looking at competitor properties around mine to see how much they're renting for and what amenities tenants get with that. Also, when it comes to rent, we can consider a bunch of other fees. So our tenants pay a pet fee each month. Some of them pay for parking. Some of them pay for laundry. They have storage units. So these are all other factors that could really help increase your cash flow. Another factor is tenant turnover or vacancy. So this is kind of inevitable. Everybody that's been in real estate for a while has dealt with tenant turnover. So ideally, you want to minimize, obviously, the time that your unit is sitting vacant, because if it's vacant, you're not making money. So try to minimize the time that it takes you to prep the unit for a new tenant and then find a new tenant to replace your old one. Repairs and maintenance can be a huge one too. So obviously, you want to upkeep your property so that it stays nice for your tenants. You can continue getting premium rent, and you just want to know that your property is being taken care of, right? So like this past year, we had a huge hailstorm, so we had to put new roofs on all of our investment properties, and also some snowstorms took down, like 30, 40-year-old fences. So those are all big investments, right? But you can make big investments in a smart way by interviewing contractors and finding the best price. And if you're not careful, they can really eat into your cash flow. Another factor is utility costs. So a lot of tenants will just pay all of their utilities, but if they're in like an apartment building or a duplex that doesn't have its own dedicated like water or gas meter, then sometimes the landlord will just end up paying those things for the tenants. Sometimes landlords will just charge like a flat fee, like $50 flat fee each month for water, or they'll bill back just like a prorated amount to each tenant. But just be smart about how you're charging for utilities so that it doesn't eat into your cash flow too much. And the last few factors are just inevitable things. So operating expenses like legal and administrative expenses. In Colorado this year, we've had a lot of changes to the legislation around renting. And so our real estate attorneys have been updating our leases. So those are kind of inevitable expenses, because we want our leases to be up to date. Landscaping like sprinkler systems, property taxes, which ours went up about 40% last year. So those went up quite a bit. And also insurance, which is also slowly creeping up. So since we've discussed all of those factors that can impact cash flow, let's talk about ways that you can make sure that your properties continue to cash flow. So like we talked about before, if the market allows, you could raise rents. Obviously, do it appropriately and look at competitors and what you honestly think that your property could bring in. So raising rents is always an option. You could look for long-term tenants. If you have less tenant turnover, that means that you have less vacancy, meaning that you're being paid more often for people occupying your unit. Also, if you have long-term tenants, we have some really great long-term tenants that are just reliable people. They pay their rent every month. They take good care of the property. There's less wear and tear. I had mentioned previously that our property taxes had gone up about 40% last year. That's because the properties were assessed pretty much at the peak of the market the year before, the previous June. As a property owner, you of course have the right to appeal your property taxes if you feel like the valuation isn't right. So we did appeal, and some of them were slightly reduced. However, there was an important lesson to be learned that when you appeal your property taxes, they don't always go down. They could go up. So just keep that in mind. I did hear some stories of people who appealed and then they actually ended up paying more money. You can also plan on renovating your property, which will go back to how much you can get for renting your property. Obviously, if you have a nicer unit, then you can probably get more money for it. So we personally aim for value add properties. I don't want to pay a premium for a property that's already been renovated. I would rather buy the worst house in the best neighborhood and fix it up myself and then optimize rents. So you can often buy properties that are old and outdated at a reduced price, put some money into it, and then rent it for a premium. So my last tip for optimizing rents is to perform some preventative maintenance. Obviously, you want your tenants to know that you care about them and your property, and you want to keep your property nice so that they can enjoy it, right? Just a few ideas off the top of my head. So the first could be like gutter cleaning. You obviously want your gutters to be clean so that water, as it rains, rolls off the roof into the gutters, down the downspouts, and then away from the property, right? Instead of clogging up in the gutters and then spilling over the gutters, it could potentially flood your basement. Another problem could be tenants not changing furnace filters. So we all know how much a furnace costs. If tenants are not changing the filter and your furnace is having to work even harder to push air through a dirty furnace filter, your furnace is going to burn out and it's not going to last as long. So just these small preventative maintenance things can really help you out in the long run. Reason number 3, I invest in real estate, are multipliers. So what I mean by this is more talking about the goal of owning more doors so that any difference that you make or any amount that you raise the rent is then multiplied by how many doors you have. So for example, let's say you own a 50-unit apartment building and you decide that you want to raise the rent on each unit $50 per month. So you're getting $50 per month more times 50 units over a 12-month period. So overall, if you calculate that your property is, let's say on average, like a 5 cap, you're adding roughly $600,000 in value to your property just by raising everybody's rent, such a small amount. At this point, you're basically doing real estate at scale. The same can go for charges like landscaping. You probably need a landscaper if you own a 50-unit apartment building, someone just to come and upkeep the grass, mow the lawn, trim the hedges, make sure your drip lines are working. Maybe you find a cheaper landscaper and you can just pocket that money. Or maybe you're paying too much for trash and recycling and waste removal, and you find a cheaper waste removal company, right? Same thing. You can pocket that money and that increases the value of your property overall. Then with the changes that you've made, you could theoretically pull out that value or pull out that money that you've now instilled into the property, and you could use that or you could snowball it into your next investment property. That's kind of the goal of commercial real estate, right? Is to just keep building. And this is great because it's a tax-free loan. And it's also being paid for by the rent that your tenants are paying anyway. Reason number 4 that I invest in real estate are some pretty hefty tax advantages. So let's get into the nitty-gritty of these. So for investment properties, you can deduct or expense all mortgage interest, property taxes, insurance, any maintenance, repairs, inspections, professional fees, and of course, depreciation. So what is depreciation? We know that most tangible or material assets do naturally decay over time just from wear and tear of somebody living in your unit. So over time, this wear and tear will naturally reduce the value of the asset because things will need to be replaced, like carpet down the line. For this reason, the IRS allows you to depreciate the structure only, not the land, as if theoretically it'll be worth nothing after 27.5 years. So it won't be worth nothing after 27.5 years. It will probably actually be worth a lot more, but the IRS allows you to depreciate it against your income as if it will be worth nothing. So for as long as you own this property, the loss, or AKA the depreciation that we mentioned, can be subtracted from your taxable income each year. So let's say you own that $500,000 property before. The actual structure is worth 80% of that value, so it's worth $400,000. So you can depreciate that $400,000 asset over 27.5 years. So that's roughly $14,545 per year that you can essentially depreciate or write off. Now, let's say you made $100,000 total that year. So you'll take $100,000 minus that $14,545, and now your taxable income is reduced to $85,455. So that's pretty broad. That's just depreciating the entire property. But if you want to be even more specific, you can do what's called a cost segregation analysis, which basically means that somebody comes out to your property and they break your property down into really small pieces, meaning like, we're going to depreciate this door handle over 27 and a half years, or a ceiling fan, or this trim over here, literally anything. And oftentimes that can actually be beneficial, especially if you have like a larger commercial building or an industrial building. So that's definitely something to consider. And usually with cost segregation studies, they actually can accelerate the depreciation of specific items, so it definitely can pay off. It's also worth noting that depreciation schedules can vary depending on what type of property we're talking about. So for a residential property, which is defined as a single family home, it can be a duplex, triplex, fourplex, or student housing. These properties are depreciated over that 27.5 years that we already talked about. But a commercial property is defined as anything over 4 units, and those properties are generally depreciated over about 39 years. So it's important to understand that distinction. Another important tax advantage could be becoming a real estate professional. Not a realtor, a real estate professional. So basically, becoming a real estate professional allows you to offset a portion of your non-passive income, or i.e. your normal day job, with various deductions from managing your rental properties. So this basically does a great job of reducing your federal and state tax responsibility. Now, to qualify as a real estate professional, you basically have to prove that more than 50% of your working time during the tax year is related to services for your real estate business. So that could be anything from development, say you're building a new property, redevelopment, renovation, construction, acquisition, you're buying new properties, you're selling properties, rental, operation, management, or leasing. The second requirement is that you must spend more than 750 hours on your real estate business during that tax year. And the third requirement is participation. So you have to have documented participation. Basically, you have to detail your participation in the business. How are you participating? Are you showing the unit? Are you meeting with contractors? Are you meeting with realtors and touring properties? What exactly are you doing for those 750 hours? Make a little log, write it all down, and then hopefully you can qualify as a real estate professional. The fifth reason that I invest in real estate is to hedge inflation. So as we know, inflation has been rising, and when inflation rises, the power of the dollar falls, which obviously we're all feeling. I had already talked about going to the grocery store. I can't get out of the grocery store for less than $100. Can't fill up my car with gas for less than $50. So as inflation rises and the power of the dollar falls, the cost of goods and services are also increasing. So as inflation rises, so does the value of your asset, right? And so as the value of your asset rises, it's protecting you, it's insulating you from the effects of inflation. This is unique because almost every other type of investment doesn't do this. Real estate is the only thing that acts proportionately to inflation, meaning that as inflation increases, so does the value of your properties and also what you can rent them for. All right, the sixth reason that I invest in real estate is to build equity. So what is equity? It's the difference between what you owe on your mortgage and what your home is currently worth. Let's say, for example, that you bought your home for $500,000. You put 20% down 10 years ago, so 2014. Interest rates in 2014 were roughly 4.3%. So let's say you financed your home at a fixed rate of 4.3% over 30 years. So since then, you've paid another $81,602, roughly $2,000 each month as a mortgage payment. So let's say your home is worth $750,000 today. So $750 minus $500 is $250,000 in appreciation, basically equity, plus your down payment, which was $100,000, 20%, and however much principal you've paid down since buying your home in 2014. So since you bought your home 10 years ago, you've got a huge amount of equity in your house. That's incredible. So we've already talked about that you're making money via appreciation. If you live in a really desirable area, you're probably seeing a lot more appreciation than somebody living in the middle of nowhere. But still, that's a huge win, right? You're also making money on principal paydown. So let's talk about the difference between principal paydown and interest. So principal paydown is the amount that you're paying down the actual loan amount each month. So principal paydown is building equity in your home. The principal amount that you're paying each month increases over time. So at the beginning of your loan, you're paying mostly interest, right? And your monthly mortgage payment. At year 25, you're paying mostly principal. So in the example above, your principal balance is $400,000. And then interest is the amount that you're paying to borrow that $400,000. So we can put all of this information into a mortgage calculator and we can basically look at the amortization schedule for it. We can see that the cost of the property was $500,000. We're putting down a down payment of $100,000, which is 20%. Our loan term is 30 years. our interest rate is 4.3%. And then you can see here, your loan amount is $400,000. If you pay your home off in 30 years, the total interest that you'll have paid will be $312,615, meaning that the total cost of your home actually wasn't the $500,000 that you agreed to buy it for. It's $712,615. And you'll continue paying on that until May of 2044. But these amortization and mortgage calculators are super helpful because you can actually scroll here and you can see that at the beginning, you're paying mostly interest. And then over time, the percentage that you're paying in interest drops. And then by the end, you're paying most in principal. Okay, so now you have all this equity built up in your house. So you're probably wondering, what do I do with it? So you have a few options here. So first, you could just sell your house. If you live in a high demand area, you could probably just sell your house. If your house is worth today $750,000, that's what you could get on the open market. And you bought your house for $500,000, you only put $100,000 down and you've been paying monthly on it. You could make a few $100,000 just by selling your house today. Now, the important point here is that you will have a capital gain from the sale of your home. Now, let's say you realize that gain, you sell your home for $750,000, you pocket, let's say, $250,000. Theoretically, you should be able to realize that gain and not have to pay any tax on that. According to the IRS, if you are single, you may be excluded from paying tax on any gain a personal home realized up to $250,000. Now, if you're married, that can increase up to $500,000. So that's also a great way to make money in real estate. Your second option is to basically HELOC your house. So you could take out a home equity line of credit and invest that money into your next real estate project. So let's say you've been making payments on your $500,000 home since 2014, but you still owe $200,000 on it, meaning you have $300,000 of equity. So you'd qualify for up to 80% of $300,000, meaning that you could potentially borrow $240,000 from your lender. Now, there is a caveat on HELOCs currently. So like current interest rates, HELOC interest rates are also high. I think ours currently are ranging somewhere from the mid 7s to mid 9s, obviously depending on if you have a HELOC on your primary home or if you are HELOCing a investment property, the rates will differ. The good news with a HELOC is that you can take advantage of an interest-only period, and you basically don't have to start paying off the principal or any accruing interest for 10 years. So the draw period is the initial phase of the HELOC, during which you can withdraw funds up to your credit limit, so up to that $240,000. And the draw period usually lasts for 10 years. During that time, you're only required to pay interest on what you borrow. So during that time, you're not paying any of the principal amount down. Now, don't let that get you in trouble. So be smart about how you're using your HELOC. You could use your HELOC to buy another asset that will be cash flowing. Reason number 7 that I invest in real estate is appreciation. Over the past 100 years or so, real estate values have continually increased. So as an example, we bought our first house in 2018. We looked up to see what our house was built for. It was built in 1972 for $32,000. That doesn't even buy you a bathroom today, like literally renovating a bathroom. So we bought our house in 2018 for $640,000. And my husband and I always like to joke that if that rate of return continues, which was a 1,900% increase over 46 years, we'll be able to sell our house in 46 years for $13 million. That's craziness. I can't fathom that happening, but it just shows you appreciation, right? So it looks like nationwide housing prices have risen approximately 3% over the past year. That's just a national average. In Colorado, I found a Redfin article saying that housing prices were up 7.3%. It's just a more desirable place to live. You would probably see similar increases in California, Washington, New York, or Florida. There's just such a high demand and a low supply that appreciation is just skyrocketing. So some factors that influence appreciation include market demand. So as I mentioned, more desirable places to live often see higher rates of appreciation. That just makes sense. Also, economic indicators. So obviously, inflation is having an effect on property values. but it's also important to look at job growth. So along the Front Range, tech companies are moving in. We're having an influx of Amazon, Google, IBM, Microsoft. Huge name companies are moving in, and they're bringing in software engineers. They're bringing in people that can afford to pay a premium for homes. And so that's just really driving up the prices in the housing market. It's also important to pay attention to location. So just as I had talked about economic indicators, look at where your property is located. Is this kind of an up and coming area, or is this area really not growing? Is it near amenities? Is it near places of employment like hospitals, schools, big tech companies, a growing downtown like Denver? What would make somebody want to move into one of your properties? So just pay attention to all those factors that could increase appreciation. The eighth reason that I invest in real estate is income diversification. So for me, real estate is yet another income stream. Yes, it's kind of my long-term play, my long-term goal, which I'll talk more about in a minute. But especially with inflation on the rise and just the cost of living going up, I just see it only as a positive. Why wouldn't you want another source of income? Real estate is also much less volatile than a lot of other types of investments. If you look at real estate overall, it has an annual return of roughly 10%. So that's pretty competitive. It beats the S&P 500, and it also beats inflation. So why not? And you own a physical asset. It's also pretty stable income, right? Because if you think about it, people are always going to need a place to live. You always need a roof over your head. So if you can be the one owning and controlling that asset, again, why not? I would say, I keep seeing online that people keep saying that real estate is passive. I wouldn't say it's passive. I'm a real estate professional. I do put in a lot of work. I manage our units currently. Once we have a bigger portfolio, I'll probably hire a property manager. But, I do put in a lot of work, like getting units ready for tenants, renovating properties, working with contractors, working with our team of attorneys to make sure our lease is up to date. And then just, I want to have a good relationship with our tenants. So if they text me, they all have my personal phone number, fixing things when they're telling me something is wrong, just paying attention, having a handyman, all those things. It takes time. It's not my day job, but it's still my job. Real estate kind of seemed like a no-brainer to my husband and I because it's kind of just a benefit all around. If you're managing your properties well, you're cash flowing from day one, you're building equity in your properties as you're paying down the principal balance, and you own and control an appreciating physical asset, not to mention all the tax benefits that we've already talked about. The ninth reason that I choose to invest in real estate is that you own a tangible asset. At the end of the day, in real estate, you own a home, a duplex, a commercial apartment building. You own something physical, right? That you could easily sell and liquefy. And physical items have value. Again, this is unlike a lot of other investments that have an assigned, or I guess you could call it like a theorized value, rather than a transactional exchange value. And again, as you're paying this asset off, you're cash flowing, it's appreciating, you're just making money in a number of different ways. So as long as you're making smart decisions, you're coming out of this holding a pretty valuable item. So my 10th and final reason for investing in real estate is setting myself up for retirement. So we started buying investment properties when we were 26 years old as part of a long-term retirement plan. And we've been growing our real estate portfolio ever since. So the hope is to continue to acquire and leverage my money for as long as possible. We'll be benefiting again from monthly cash flow, from appreciation, and from the tax benefits that we previously discussed. But now I feel like it's the time to mention the 1031 exchange. If you've been in real estate for a while, you've probably heard this term used quite a bit, but what exactly is a 1031 exchange? A 1031 exchange is basically a type of a transaction that allows investors to sell their investment property without having to pay capital gains on it, as long as they reinvest that money into their next property. The IRS says that it has to be of a like kind. There is some leeway on this, but in theory, let's just say you're selling a single family home and you're 1031ing it into a new single family home, or you're selling a commercial apartment building and you're 1031ing that money into another commercial apartment building. So without the 1031 exchange, It depends how long you've owned the property. If you've owned the property less than a year, you would be paying short-term capital gains, which depending on how much money you make can range anywhere from 0 to 20%. If you've owned that property for more than a year, you would be paying long-term capital gains, which is then just taxed at your ordinary tax bracket. So that could be up to 37%. So let's say, for example, you sell a property and you make $100,000 in profit. Without a 1031 exchange, you would basically just be writing a $37,000 check to the government. With a 1031 exchange, you're essentially deferring these tax payments until much later, like whenever you want to make your final real estate sale without purchasing a new property. You can also have your properties in an LLC. It could be passed on to future generations. Another limitation, aside from buying a like-kind property, is some timing requirements. So you'll need to identify or find the new property that you're planning on purchasing within 45 days of selling the previous property, which can be pretty difficult to do, especially in today's market. And you'll need to close on that property within 180 days to avoid paying any capital gains. Now, it's important to point out that even if you do find a new property to invest in, you might still end up owing some taxes if the mortgage on the new property isn't the exact amount that you profited from the sale of the previous property. So if you profited $600,000 from the sale of your previous property, but the mortgage on your new property is only $500,000, you could theoretically owe tax on the $100,000 difference, which is known as a boot. You could also owe some money in depreciation recapture now that you know a little bit about depreciation if you've owned the property for multiple years and you have been taking depreciation deductions. So make sure that you're referencing the IRS website, your accountants, and your team of real estate attorneys. All right, so all that to say, am I buying real estate now in this market? And the answer is yes, absolutely. Since rates are high, we're seeing properties sit on the market for a longer period of time. So my personal approach is, why not submit a lowball offer? If nobody's bought your property in months, maybe even years, I think it's fine to submit a lowball offer. What's the worst that they can say? No. Now, in some cases, like in Colorado, a more desirable place to live, people aren't adjusting the prices. And for some reason, they're fine with just letting their house sit on the market for years. Fine, I don't need to buy that property. But in some cases, people actually do need to sell their home, whether they're moving for work or they're moving to be closer to aging parents. I mean, there's any number of reasons, right? And so it's worth submitting a lowball offer and just seeing what they have to say, right? It's also important to have your realtor, whenever they submit an offer, try to use today's interest rates as a bargaining chip. Now, the commercial real estate market is kind of a different story. So as we were talking about before, their terms are usually 5, 7, or 10 years. And so people that locked in those terms 5, 7, or 10 years ago, and they're coming due now, are kind of in a world of hurt, right? Because they're having to either sell their property and probably take a loss, or they're having to refinance into interest rates that are 7%, 8%, and they probably won't be cash flowing anymore. So they just need to offload the properties. So that's what we've been looking for. You can look on Crexi, LoopNet, any of those websites, but also reach out to some of the brokers too, because I almost think it's more important to be buying off-market deals. It kind of seems like all the stuff that actually makes it to those websites are things that nobody else wanted. So I just wanted to show a few examples that I found on Crexi. So this property, while it's beautiful, it's listed a cap rate of 4.43%, meaning you're going to get a 4.43% return on your investment. So considering interest rates are upwards of 7% right now, you're basically putting down millions of dollars to lose money each month. So I'm going to hard pass on that. As you can see, it's been on the market for 414 days. So nobody else is falling for this either. But, you know, they kind of built this at the wrong time. So I'm sure they're in a world of hurt. Here's another one with a cap rate of 5.99%. So it's a great looking building. It's a little bit closer to breaking even. But again, you're going to put down a lot of money here to just break even. So anyway, at the end of the day, you have to do whatever works and makes sense for you. But with the market being what it is, I would say a lowball offer is definitely worth it. So right now I'm looking for deals every day. I'm even looking at foreclosure auctions in my area, making lowball offers, like I said, especially on properties that have been sitting for a while. So Just be patient and the right deal will eventually pop up. Those are the top 10 reasons that I choose to invest in real estate, and I'll continue to do so. If you have any of your own real estate investment stories, leave those in the comments down below. I would love to hear from you. As always, feel free to follow me on my social channels here, and I will see you in the next one. Bye.